especially because more people we know right now are carrying that credit card debt. We also spoke with George Kamel about the impact your credit cards are having.
A lot of people right now are turning to credit cards as a crutch to survive this recession. And let me tell you, that's not a good plan. These credit card companies are not your friend. They're not here to help you. The interest rates can be as high as 20 to 25%, and it's going to hurt you in the long run. So here's what I want you to do. Pay off your cards, cut them up, and stick to a debit card. That's going to help you emotionally when it comes to spending and reining in that budget.
You know, one of those things, too, I think they say, you know, cash is king. So I wonder, like, should we just be trying to pay with cash and get rid of the credit cards?
Well, I think it becomes a balancing act, like anything. I certainly would concur that to the extent you have debt, particularly on high interest credit cards, you really want to attack those first. I believe the last report on average, credit card interest rates are over 18%. It certainly will, and I would expect go higher because the credit card companies are using a variable rate approach. They can adjust as quickly as the market adjusts, and the market is adjusting with our expectation for the future. So yes, attack first the high interest debt and then work your way down. And in the meantime, to the extent you have cash available, maybe cash you preserved and saved during the pandemic, maybe it's time to leverage some of that. But you also have to maintain a rainy day fund.
Yeah, you know, I wanted to try to conceptualize this and say, what does this actually mean in terms of our money? So Bankrate actually came out with this. They said the minimum payment on a $5,000 balance on your credit card, 18% APR. Currently, you have $870 that you're paying just in the interest if you're doing the minimum payment. Now, with the move from the Fed expected to be that 75 basis points, it's going to balloon to $1,161. That's just an additional interest, Dr. Marks.
And we saw gasoline prices. It hits us right smack in the face. And that's what we as consumers need to be aware of. At the same time, we also have to realize we may focus so much on, let's say, food price increases or the credit card debt increases. There have been some offsetting factors. Look, gasoline prices have come down for 99 days on average in the country. Today, we finally had a blip up. But for the most part, with a slowing of the economy, which is expected, we can see that energy prices may establish an equilibrium that will satisfy most consumers from that perspective, especially in real terms, it's lower. And we'll see other prices coming down. But yes, I caution everyone, be careful of the debt you incur because the cost of carry, that interest, will eat away at your disposable income. It's sort of a stealth tax, if you will.